In this lesson, we will learn how to run multiple asset allocations and compare results. We will also see how the Smart Asset Picking tool can help us to quickly identify the best choice among tens of available asset classes. Let's start with a hypothetical client with his own existing investment portfolio. Let's also assume that using Portfolio Analyzer, another tool available in our software, we have converted current portfolio's holdings into the following asset classes. We can now build an efficient frontier with those markets and see how it looks like. Let's suppose we are looking for a 4% annual return. This is the right allocation. With a 3.99 expected return and a volatility of 8.68. Let's now go one step forward. What about introducing other markets in our optimization process and try to reduce the risk borne by a 4% yielding portfolio? We have just run an optimization with 5 markets, those currently held by our client. But what about adding few more markets? The real question is, which market should we add to the previous optimization process? Which is the best pick within a full list of 114 available markets? The Smart Asset Picking tool can help us with this task. Let's see how it works. Let's focus on our starting portfolio. It holds Equity Germany, Equity USA Technology, and your gov is 1 to 5 years. We now ask ourselves the following question. Which markets provide the higher diversification power against those in selected portfolio? In other words, can we include other markets that drive down portfolio volatility against our 4% of target expected return? To quickly answer this question, we can use the Smart Asset Picking tool. Step 1. Lock the markets that we want to preserve, those in our 4% yielding portfolio. Step 2. Run analysis. What is this? This is the full list of all available markets, sorted by descending diversification power. In this case, gold is at the top of the list. It means that this is the market that mostly diversifies an investment portfolio based upon the markets flagged in the above box. Furthermore, it has an expected return of 5.2%. We will consider it for sure. Now, what about adding an equity market in our new efficient frontier? We can look for the best equity choice, filtering the list below. This is the best choice among all available equity markets. Its diversification power is lower than that of precious metals, but it's the best possible among equity markets and bears a good expected return. Let's recap what we are doing. We had an initial portfolio with 4% expected return and 8.7% expected volatility. It was based on the following markets: equity Germany, equity US technology, and Euro govies 1 to 5 years. With the Smart Asset Picker, we found 2 more markets that could enhance our starting portfolio. These markets are gold and equity USA utilities. We now expect that an efficient frontier built upon all of these 5 markets will provide us a better diversification. It means that a 4% yielding portfolio should bear a volatility lower than that of our original portfolio. Let's build another frontier to check if it's true. This is our new efficient frontier. We can zoom the chart looking for a 4% yielding portfolio. With an expected return of 4%, we bear a risk of 6%. We can now compare 2 different portfolios. Portfolio 1, 12% equity Germany, 36% USA technology and 52% European govies 1 to 5 years. 4% 1-year expected return and 8.68% expected volatility. And Portfolio 2, 12% equity Germany, 16% USA technology, 48% Euro govies 1 to 5 year and 24% precious metal. 1-year expected return is 4% and 1-year expected volatility is 6.06%. We have reduced total portfolio volatility by 30%, maintaining the same 1-year expected return.